So you know how life is super busy and there's so many financial products and there's so many financial people, it's hard to make financial decisions? I'm Adam Gane, owner and financial coach of Gane Financial. We help families with businesses as a one point of contact to integrate, coordinate, and organize your whole financial economy so you can save time and energy and live the life you want to live. Okay, so in our last meeting, we talked about the reasons why we want whole life insurance. One of those reasons was to maximize retirement income. And so I want to go into a bit deeper dive into that. How does that actually work? And let's go over an example with person A and person B.
Okay.
So let's assume that person A and person B are both 65 and they both have accumulated $1 million of assets. Okay, so before I get into that example, let's just talk about the three phases of life that we go through. There's three main phases. The first phase is about accumulating money. So as we accumulate money, we're climbing the mountain throughout our life. And we want to grow those assets over time. And I would say 99% of conversations are all about accumulation of money. And we get to the top of the mountain and we plant our flag and we say, we did it. Now how the heck do we get down? And this is the distribution of money. So how do we spend the money that we've accumulated? And that's what we want to talk about. Very few people are talking about distribution of money. And we're going to see why it's important to discuss and position yourself in the accumulating phase. The last phase is around preservation. And this is talking about, I know I'm going to have money left over. How do I give it to the next generation in the most effective way? So there's three people that you can give this money to when you pass away. It could be friends, family. It could be charities or churches. Or it could be the CRA. Now,
who we can't avoid.
So if you don't plan, the system is designed to give to them. If you plan, we can eliminate as much as possible and give the most to the other two. Okay, so let's go back here to a distribution of money. Now, so you've got, let's look at person A first. So you've got $1 million of assets. And you've just transitioned.
Spendable assets?
Spendable assets. So you've just transitioned from working for money, accumulation, to money working for you. And you now have 1 million worker bees. How many of those worker bees do you want to lose in retirement?
None.
None, right? Now, what do you think the biggest risk in retirement is?
Outliving your money.
Yes, I'd say so too.
Exactly. We don't know how long we're going to need this money. You could live a really long life. And if you tell me the exact day you're going to die, I can make an amazing plan for you. Because we can spend all of that money.
100.
I'll say 100, okay. So that's one of the biggest. Now, there's a whole bunch of other risks that we have to be aware of, but the longevity factor is huge. And that's why we don't want to lose those worker bees, because this is now the business that has to create an income for life. And if we lose any of those dollars, there's less worker bees. There's less money producing for us.
Totally agree.
And so, you know, we typically think about different ways we can spend in retirement. A lot of people think, okay, well, I can just live off my interest. Well, what do you do if you have a down year? Spend negatively? No, you can't do that. Because you're going to have up and you're going to have downs. If it's invested, well, I'm going to put it in a guaranteed investment. Okay, so you're going to earn 1%. Or 2%, 3% right now. So that's also tough. So we want to look at what other strategies are available. What I'm seeing most of the time is people are taking arbitrary amounts out. And it's not a long-term plan. And so, for instance, person A walks in and they talk to their advisor and they're saying, you know what, I think I can make 14.87% if I invest this money long-term, average rate return. And I'm sure their advisor's like, well, that's a lot. But if I could do that, then I can take out $100,000 per year and I'll be fine. I've got $1 million earning 14.87. That's close to 150,000 with no taxes, no fees.
Right?
150,000.
Yeah, they'd probably be okay.
Okay. So well, let's take a look at this example for a second. And yeah, this might be a large rate of return, but we need to validate this.
Yeah, okay.
Okay. So here's your million that you've accumulated. You're 65. And let's assume a 30-year time horizon. But you could live past 95. We don't know that. So we want to make sure you have money available even at 95.
Okay.
Here's your 14.87 average rate of return. And here's your beginning of year balance and your end of year balance. And if you can see, if you don't take anything out of this over a 30-year period, your net result with no taxes and no fees, it's going to grow to 64 million. Well, that looks great. But we need income. So let's take this 100,000. So I want you to watch this net result for a second.
Whoa.
So it went from 64 to 15.
Right, and you haven't even taken out taxes yet.
And yeah, I'm not going to deal with taxes and that stuff. We're just going to keep it really simple.
Okay.
So you took an income of 100,000, and over 30 years, that was $3 million. But how much did your net value go down?
It
Went from 64
to
15.
15.
It's almost 50,000,
yeah.
50 million.
Yeah, almost 50,000.
What?
50
Why?
million.
But you only spent 3 million.
Yeah,
So how did that happen?
What happened? What do you think?
but there's no capital to invest. Like the capital kept going down.
Because you took out the 100,000 every year.
Right. So not only do you take the income, but you lose that income to accumulate and to compound. So it's lost opportunity cost. But we have to take money out.
Right.
But we have to be careful of how we do it. Now that's why things look great in the accumulation phase. We're adding money to it and it's compounding on compounding and compounding. Well, when we start taking money out, that net result is not going to be as big, obviously, if we didn't take money out.
Right.
So it's just being aware of lost opportunity cost. But we need to spend money. And what do you think, and this result is well, you got 100,000 of income and you got 15 million at the end. Like, it seems pretty good. But what do you think is a little off in this scenario?
The 14.87.
Okay.
Like last year, we lost on our investments.
Right. So, okay, 14.87, even if I could get that, do you think I could get that exact rate every single year for 30 years straight?
No, of course not.
No.
That's
No.
impossible.
There's volatility, right?
Goes up
Market's
and
going to
down.
go up, market's going to go down.
Some years you lose 14%.
Right. So the reason I'm using this 14.87 is because if you retired in 1970 and you invested in the S&P index, the large cap, you would get an average rate of return over those 30-year period of 14.87.
Oh, that's surprising.
Right. But what do you notice about your assets?
The assets are going down.
Yeah. See, that we actually run out of money in year 13.
Because of those big drops.
Right.
Oh, you changed all the rate of returns.
All the rates, these are the actual rates of
The
return.
actual rate
This
of
is how the
return.
actual stock market,
okay.
how it worked.
Yeah, okay.
right? So before we were just showing the 14% average.
Yeah.
In reality, sequence of returns or each return in sequence matters, especially in retirement.
In 69, you lost
Yeah,
26%.
wow, look at
Yeah.
that. Yeah.
And it really hurts us.
You lost the year before.
Yeah, it really hurts us when we have a down year. Not only do we lose from our portfolio, then we take out another 100,000. So it's like kicking a dog when it's down. That's really hard on our portfolio to come back to life.
Yeah.
And in reality, what's really going to happen in this scenario, if someone retires the first couple of years, they're going to be okay. They're probably going to be like, I'm going to still live that 100. This year hits them, they just lost almost 25% of everything they've ever saved their whole life. And then this year hits them, They've now down to 50% of everything they've ever saved in their life after 5 years of retirement.
Yeah,
What are they going to do?
They're gonna stop taking out 100,000, that's for sure.
They're going to stop the 100,000. They're probably going to take money out of the investments, right?
Yeah, that happened to a few people in '08.
Yeah. So what happens? Well, you lose the next rate of return.
The next jump.
The next
Oh,
year.
because you've taken
in the
some money
market.
Because you
out,
took it
that's
out.
551.
Right. So you have to be very careful in when you're spending down money, the distribution of money. So what the industry has come up with is something called the safe withdrawal rate. And what they've done is they've created a probability of success. So we don't know what the future holds, but what we can do based on a certain portfolio dimensions, like whether it's in equities and bonds, we can create a probability of success.
Okay.
And what they do is they create a chart, something like this. And so the different lines represent equity to bond mix, different line colors here. On the left, you've got probability of success. So there's 100% of success, and there's a 0% success.
Okay, wait a minute. Equity to bonds?
So stocks, like
Yes.
stocks or bonds.
Okay.
So if you look at this line, you got like a 60-40 or a 40-60. So like we're pretty much just looking at these middle ones here. Now, if we want a 90% chance of success, then you can take out the bottom line is your withdrawal rate, how much you can take out of your portfolio per year.
Like the interest rate.
It's just, no, it's not the interest rate, it's withdrawal rate. Yeah.
Withdrawal rate.
How much can you take out of your portfolio? It doesn't matter what interest rate you get. It's going to go up and down. But we can only take out 3% per year if we want a 30-year retirement period.
3% of
The
your
portfolio.
gross assets?
Yeah.
Of the total capital.
Now this is a little bit outdated because of bonds now have increased in the last year. You know, we're probably closer to more 4% for a 90 if we do an update. So it does change over time. So we have to be conscious of that and what's appropriate. The thing is though, if you have a 90% chance of probability, that means there's a 10% chance of failure.
Yeah, right.
Yeah.
So if you're going to get on the plane going to Florida and they come on the announcements and they say, just so you know, we only have a 9 out of 10 chance of getting to our destination today.
Yeah, right.
I feel like a few people are getting off. Yeah. So that's the best that we've come up with. We can't, so I'm going to just say between 3 and 4% right now is that safe withdrawal rate. Anyone taking more than that right now could potentially have a lower probability. And I think a lot of people right now are just taking arbitrary amounts out, not really having a plan and setting things up long term. Well, 3 to 4%, that's 30 to 40,000 a year
I was going to ask you that.
Yeah.
That's right.
out of your million.
Say-
But you've
say average
accumulated-
25.
You've accumulated more than most Canadians. $1 million. There's very few Canadians with $1 million at retirement. And that's only 30, you can only spend 30 to 40,000.
Way to go, Sean.
So at this point, I'm guessing you hope person B is a little bit better off.
Definitely, yes.
Yeah.
Okay, any questions on
I'm
person
anxious
A?
to see what person B is
We're
going
gonna-
to do.
Kill them off early so they have lots of money.
Well, that's one way to do it, yeah. Okay, so person B has one thing that person A doesn't. What do you think that is?
Oh, it's going to be the whole life insurance policy.
That's right. They have a whole life policy with a guaranteed death benefit. We're going to say the death benefit's $750,000.
Now, is it on both of them, husband and wife, or just one person?
There's lots of different designs we could do. Let's just say it's a joint last to die.
Joint last to die.
Okay. Now, to compare apples to apples, what we've done. Hopefully, I met these people when they're at least at 55. Like at any age, we can do this. but it takes time to get money into the policy. So let's say this $1 million, they've actually got 750 of investable assets, and they've put
750 of cash? Oh, no.
of investable assets.
Okay.
And they've
Instead of the million.
and they have 250 of cash surrender value.
Oh, okay.
So the cash value of the whole life policy.
Okay, so they just took
Okay.
their
They've, they-
250 and
Yeah.
put it into the life insurance.
That's right. Instead of putting all of their money into stocks and bonds throughout their life, they took a portion of it, about 25% of it, and they've moved money into the whole life
Oh, okay.
over time.
Okay.
Okay? So the question is, without looking at the cash value for a second, how can a death benefit help you in retirement?
Well, it doesn't. Because
Because
if it's last to die, most people are gone. And then it goes to the family, so it's legacy.
right. Okay, but we do know that money's coming to your beneficiaries at some point.
Yes.
Can you guys agree that everyone's going to pass away at some point?
Yes.
Okay.
I definitely.
So we know that there's going to be a transaction in the future that money is going to be injected into someone's account.
Yes.
So that means that if you know money's coming in, you might be able to spend money somewhere else before that money comes in. Okay, so here's a scenario. If I can give you $100,000, 100% guaranteed a year from today, would you feel bad at all if you spent any of that 100 before you got it?
Nope.
Well, assuming it was
I'd
guaranteed.
go and buy
100% guaranteed. Find another boat.
You said guaranteed?
100% guaranteed it's coming to you.
Yes.
You
If
would
it was
s-
guaranteed, yes, I'd feel okay to do that.
Right. So, what that does, a guaranteed death benefit, allows us to spend and enjoy all of our other assets outside of the insurance as a permission to spend. And so now we can spend the assets we have. We don't have to, we can spend our worker bees because we know they're all going to get replaced. And that opens us up to a whole bunch of strategies.
Because it's 750 a whole life.
That's right.
100 So that's it, okay.
It's going to get replaced.
Death benefit.
Death benefit, yeah,
Right.
yeah.
So
Yes.
now we can take the 750 and there's a ton of options open to us. One of those options, we can go buy a pension. You can actually buy pensions. And you take that 750, you say, here's 750, give me a guaranteed income for life. And at 65, right, today's rates, you can get 45,000 guaranteed for the rest of your life.
What's that rate?
What do you mean the rate?
The interest rate that you're getting on the 750,000 that you.
There's-
of course
there's
you
no
would not
interest
know
rate.
Because it's for life.
Exactly.
You would
can't-
never know.
yeah.
So
Yeah.
we're taking out, by doing something like this, we're taking out the biggest risk in retirement. We're guaranteeing you an income, no matter how long you live. And if you pass away early, that 750 gets replaced. And if you live a long life, you're going to have that income forever. Now, there's other options
Right.
available, but the pension is nice for a certain amount of your income so that you can cover your basic living needs. We're going to talk about another strategy in a second,
Okay,
but does this make sense so far?
yes.
It's more just understanding what we're trying to do is we're using the death benefit to spend and enjoy money outside of the life insurance. And we call this asset insurance. This strategy, we call it asset
So you're
insurance.
insuring your 750,000.
Exactly. So,
So we can spend it.
right. The definition of life insurance is to cover the main income producer. And we typically think of life insurance to cover us when we're working, but when we retire, our money becomes the main income producer. So we change it, we start calling it life insurance, now we call it asset insurance. And we protect our assets so that they all get replaced.
We're
Yeah.
insuring the worker bees.
Right, we insure the worker bees. So the cool thing about the pension is also we didn't talk about fees at all, but there's 0 fees for this, and there's very minimal taxes. Plus, there's a lot of other options, but this is one of the
there
main
less
ones.
taxes than with the person A?
Oh yeah, because A is paying taxes on any growth of that million. Typically,
Oh, and also
they're probably
fees.
utilizing some tax advantage stuff, but they're probably gonna have to pay tax on a lot of it. Okay, so let's talk about the next best thing the next strategy.
You've also got the 250,000 still
Right.
in cash now. Is that
Perfect. Glad
is
you
that
brought that
just
up.
staying always the same, or is that going up or down, or?
That 250 over time is just going to keep going up, but we're just kind of looking at a point in time, and so let's talk about that cash surrender value now. So you've got 250,000, and that is your money that you have access to, if you want. We haven't touched it.
Yeah.
So you can see in the first strategy, asset insurance, we used 750,000 and created more income than with $1 million over here.
And that was because of taxes? No, because we didn't
The
include
market.
taxes. Oh, it was the
market.
fluctuating market, that
Yeah,
was it.
market going up.
The volatility of the market, which is there, yeah.
Right.
Okay, and did that also include the fees that you have to pay for when you invest things?
Yeah,
Okay.
yeah, that does include the
Okay.
fees, typically.
Okay.
Now, fees can change depending on
Yeah.
what you invest in. So let's talk about this cash value, and I want to talk about a strategy that we call sequence defense. Oh, actually, by the way, I forgot to mention one thing. So going back to asset insurance, what we're trying to design for our clients is a 1-to-1 ratio death benefit, guaranteed death benefit to assets. Okay, so if you have
Spendable assets.
spendable assets. So if you have 2 million of assets, we want 2 million of guaranteed death benefit. And that's in the ideal world, because then you can spend and enjoy all of the assets.
Then, yeah, you don't have to think about it, you don't have to worry. Yeah.
Right. Okay, sequence defense. We're going to go back to our original example. Now, of course, we don't have the million anymore. We have 750 of investable assets. And instead of taking 100,000, we're still going to take 10%, which is 75,000.
Oh.
Okay. So,
Wait a minute, if we did the pension though, we'd only be taking 45.
so just forget the pension for a second. This is a totally different strategy.
Oh, okay.
We're just going back to the beginning. So this is just one strategy with
Okay.
using the whole life.
Oh, all right. Okay,
We typically use them together. I just wanted to kind of give you an idea of how it works.
Okay,
Okay, so we're back to this. We've got 750 and we've got the cash value.
okay,
And we're not really worrying about the death benefit now.
okay.
So remember before, we ran out of money in year 13
Yes.
in person A. So we're in the same scenario. We're still running out of money in year 13 because of sequence of returns.
Right.
But we talked about what a down market does to your portfolio. And not only do you lose the money from the down market, but you lose the money when you take extra amount. It's like kicking a dog when it's down, right?
Right.
But when do you know you lost, when do you know you have a down market? Before or after?
After.
After, of course. So we're never gonna know until after. So what this strategy teaches us is like, why don't we take from a non-market correlated asset a year after a down year and let our portfolio come back to life?
Okay, sounds good.
Okay, so we have a sequence defense. And this has to be non-market correlated. We don't want it going up and down with the fluctuations of the market in any regard, whether it's real estate, whether it's stocks and bonds, any type of investment. We want something guaranteed.
Right.
Well, we have that cash value. It's going to go up forever, guaranteed. We can access this through a loan at any time, no questions. So what we're going to do is the year after a down year, so we had a down year in year 4, in year 5, we're going to take from our sequence defense and we're going to leave our money in our portfolio.
Okay,
So this is 2023. 2022, we had a down year. This year, for clients, we don't want to take out of our portfolios.
Okay, we're gonna take out a loan from the policy.
That's right. So let's do this once. Now watch this net result.
Oh, and we still take the same amount of money?
We're still taking 75,000.
Okay.
Yeah.
Okay, good. All right.
Watch that net result. By doing this once, so it's about 3 million difference, right?
Right.
So by taking money and using the sequence defense once, we can now last for 16 years.
Oh, wow.
And how many years was the other one?
13.
13? Okay, we gained 3 years.
Okay. Well, we had another down year in year 5. Let's do the sequence defense again in year 6.
Okay.
Look at your net result now. It went from 4
4 million to
7, another 4 million that it went down by. That's only doing it twice. And now we can last with 75,000 of income till year 25 by doing this twice.
Another 9 years.
Yeah. And now let's do it one more time. We had another down year in year 8. We still have some cash value left, and your cash value really over these years has been growing.
Right.
Now you might ask, are we going to pay these loans off? Because we borrowed from the policy.
Right.
We can let them accumulate. If your portfolio gets to a point where it's appropriate, we can pay it off. Depends. We have lots of options. But let's do it one more time. And you can see the net result now is positive. We're doing it year 9. And now we can last all 30 years with $75,000 of income.
Wow.
Amazing.
Holy. And $1 million still.
We gained
still
Yeah.
almost
assets.
more than 2 million there.
Right. Now, what do you think the biggest risk in this strategy is?
Biggest risk in this strategy. Maybe we'll have more than 3 down years.
That's right. You could run out of sequence defense. So it is important to do both strategies. You do need you do want some guaranteed income. And I like to set up a guaranteed income for up to your basic living needs, and then we can use sequence defense and get 10% of the portfolio out, usually 8 to 10%, for the remainder to create more income that you can enjoy your life more. So,
Okay, wait a minute. You just said that we'd be using the 750,000 to get a $45,000. I guess it
This is a
doesn't
different
matter.
one. This is a different strategy.
Yeah.
I'm just saying, I just showed you one or the other. In reality, we use both together.
Right, and so you wouldn't probably use the entire 750,000 to get the pension. You'd probably use a little less.
Exactly.
So got it.
And it depends on where you're
Still
at.
have some assets that you can.
Right.
You'd also probably want more than 250 in your cash value.
Potentially. So
Well,
it depends.
It'll be growing over 30 years, other than the money we take out.
Yeah.
No.
But if you're starting with,
Yeah, that's right.
It
say,
grows.
500, it'd be much safer, right?
Ideally, what we're trying to do for sequence defense, so we look at this 1-to-1 ratio when we're creating your models, but also we want to make sure we have at least 25% of assets within cash value, your cash surrender value. So if you have 25% of your assets in cash surrender value, so you can see in this example, out of $1 million, you've got 25%, 250. That's usually enough to cover you for 3, 4, or 5 sequence defenses
Okay.
and to create a pretty good income.
Most people are real
Okay.
estate heavy, so they have a lot more in real estate than they do in their spendable assets. So
You can,
what do you do in that situation?
well, it depends what their strategy is in retirement for real estate. A lot of them, they want to sell those, and then what are they going to do? Or if they've paid off their mortgage enough and they can live off the income, then that's great. It depends on the scenario, but maybe they want to use some of the equity in their house to spend and enjoy, let the death benefit pay out the house at the end.
Okay.
Yeah.
Makes sense.
Yeah, I guess it depends on the
It
individual.
depends on the situation. Any questions on person A, person B now that you can see that?
Well, you can see the advantage of being person B, for sure.
Yeah, so you should really start, like if you're just starting at 65, you're gonna have a hard time getting all that money into the policies.
Well,
Should
depending
be
on how much money you have.
Starting
to
when
start
you're
with.
much younger.
If you
Yeah,
have more money, you can get it in faster.
that's right. Yeah. Well, it depends. So I always say, you know, I can help everyone, but I can't save everyone. So it depends. The earlier we start this, the better, and the lower the cost of insurance is. So it's nice to get a bunch of money into the whole life earlier and then focus more on the assets accumulation later.
Yeah, you can see that. That'd
Yeah.
be a big advantage.
So without the insurance, we're kind of left with person A.
That's right. Most people are person A, yeah.
Yeah.
With whole life, guaranteed the death benefit, yeah. All right.
Great.
That's
Well,
it.
that's
Yeah.
very interesting.
Yeah, thank you.
Thanks a lot for watching that video. Check out some of our other videos. Subscribe to our channel. Feel free to reach out anytime. We're looking to work with great people long term.